All right, and I believe we are live. Hello, everyone. I'm Eric Zollinger for State of RE. Jason, let's kick it off.
Ready to go, guys. We got a busy week. You could do these things daily. There's so much real estate news these days, but why don't we just jump right into it? Sound good?
Let's do it.
Awesome.
All right. Topic number 1 for the week. What should we talk about? First topic.
Is now a good time to buy? Interesting question.
Is now a good time to buy? We get asked this question. I think there are like 3 questions that get asked basically to every real estate agent, no matter what market you're in. 1 is now a good time to buy? 2 is how's the market? 3 is what's with mortgages? But this it's interesting, Greg, because you know what I tell people? Everyone lives in a local market. There is no one market. And the dynamics are different
in a series of submarkets.
Every submarket. So that's why the national real estate picture can only tell you, so much. And it really is about your local market and understanding the fundamentals there, because they could be a mile east. They could be different. So all real estate is hyper local. And national trends are only a guide, but not the Bible for you.
Well, I think it's important to jump into some of the most basic fundamental facts, right? So interest rates have stabilized. They're really hovering around that 6% range. We haven't had a huge drastic shift that a lot of people were projecting. As you can obviously see, we're at year over year up 6.1% from June, or flat at 6.1% rather. And the reality is, I think buyers are finally falling into a realization that rates are not going to go down. If anything, there's actually a shift happening in the projection markets. The predictive markets are starting to think that there might actually be increases coming. But either way you slice it, we're not expecting some giant windfall or drop down to 3%, from 2020. And so buyers can only wait so long, right? People have growing families, and people at the end of the day have to make decisions, whether it's, the tough ones, right? Death, divorce, and those 2 topics tend to lead towards transitional things in regards to buying or selling a home. With a flat rate and things not changing, I think what's going to start to happen is that the market is going to soften, which is what we are seeing. At the end of the day, growth in the price points of the country, generally speaking, the median increase was only like 0.04%. It's very, very stable. But that will lead to more inventory coming online and sellers realizing that, all right, I do need to move, right? My family is growing. So with what is happening, I think you actually have to, the answer to the question, is now a good time to buy, is very, very basic. You have to look at fundamentals. Owning real estate is a savings mechanism. And given that the market is not having big ups and downs, you shouldn't really looking at it. You shouldn't be looking at it as opportunistic. You need to look at it as fundamental. And so my answer to that question is, if you want to save money and potentially have upside, buying a home is better, because right now there isn't some massive drastic inflection between renting versus buying. It's more of a fundamental decision at this point. Do you want forced savings? And so my answer is yes, it is a good time to buy.
And you know what happens next year with your rent? It goes up.
What?
It goes up.
Yes.
And the year after, it goes up.
Again.
30-year fixed mortgage, like I said earlier, one of our earlier episodes, one of the best financial products ever created. You get none of the risk and all the upside, right? Mortgage rates go down, you can refinance, get a lower monthly payment. Mortgage rates go up, not my problem. I'm locked in, right?
And most people don't realize that the foundation and creation of the 30-year was an enhancement that was created to go out of the Great Depression.
Yes, and it helped a whole generation create wealth. And we've seen, and it's a uniquely American product. It was first launched here, and it's one of those rare instances where you get so much benefit and you get to de-risk at the same time. If you in a fixed rate, and I think in this day and age, people like that. So yeah,
it looks like we might be transitioning to our next topic here.
I think
Eric, is that your cue? Yeah, is that our hint to us, Eric?
Apparently
Yes,
so.
it is. Yes, it is. Sorry, I'm trying. I'm a tree. I can bend. I'm learning all this. So yes, we are ready for the part 2.
Okay, so I'm guessing that says best for first-time buyers to finish that sentence. Is that right? Or is that
Yes. My that is a very good amendment to my statement, which is it is a perfect time to buy if you are a first-time home buyer. If you're looking at it in market segments, very specific areas, for example, parts of Florida or, Texas that have seen these massive booms, maybe you wait a little bit, but generally speaking, it's a good time to buy.
Well, not only that, but we do talk about people who are in their 20s and 30s not creating wealth, and that the income inequality based on age is very steep right now for most in that generation, and that this is the kind of thing that really helps reverse that if you get them into a home to accrue wealth over the long term. So we have a home ownership, first time home ownership, the age has trickled on up and up and up and up, which is a problem in our country right now because too many people don't buy their first home until they're in their 40s, as opposed to in their 30s or even 20s. And that's decades of rent payment, but no appreciation on wealth. And so we'd like to see, there's these moves on these starter homes. There are these micro homes that get built, which, there's pros and cons because they obviously are very small. And some people, the way that they're done in some communities, it's like the same small house over and over and over and over again. So it looks a little show-like. It wouldn't hurt to have some originality in the sort of the design. And so not every home is identical. It's a little static, I think, for most people. But the idea that if you can buy something that can work for you, it's still going to be better than renting, even if it's not your be all end all. And so, there's this movement on micro homes and sort of more efficient layouts that allow you to live in them, even though the footage is smaller than we would have seen 10, 20 years ago.
Well, I think it's important. So obviously in closing on the rate topic, I think that we've all settled into where rates are. They're not going to change dramatically. There could actually be a slight uptick, but you're not going to see any kind of a significant drop. But a data point worth noting is the National Affordability Index, which tracks what a median income in the United States can afford and whether or not it is affordable to buy or unattainable. And back in March, it peaked at 116.5. What this means is, just to give you a sense of how the affordability index works, anything over 100 means that a family making the median income cannot afford a median home. They don't qualify, their financials do not qualify to get a mortgage that would then qualify to receive or purchase a median home. That number has actually ticked all the way down. I'm just pulling up the latest report. In June, it dropped from 116 all the way to 102.3. And to give you a sense of what that means, we are very, very close to again getting to a place where a median family income will qualify and be able to maintain the expenses of a median or median mortgage. So it's actually a good thing. A lot of people have been talking about affordability as being incredibly concerning, and I think it's a very, very big problem on the rental side of the market. But what we are seeing on the purchase side is actually that the affordability index is showing that we are getting closer and closer to a better place. We were in a very, very bad place back in March, but we're getting to a place that is a little bit more tenable.
Better.
A
lot of work to
not
go.
Great.
Long way to go. Right.
So I think we probably want to move on to our next topic because Eric's going to yell at us soon.
Okay.
What do we got, Eric?
New NYC housing proposal aim to ease credit. Is the next word burden? Like guessing on the word.
Yes. So this is a local topic for everybody watching. This is a very local topic. So what is happening in New York City is that the mayor is working on a new proposal that a rental building can only select one of two application requirements. They can either ask the client, the prospective tenant, to provide their credit or their income. And I think that we could probably use the entire show and the next 10 episodes to dispute this, to go over this topic. But let's hear your take on it first, Jason.
So look, you can. I have seen this firsthand. Remember, I'm an agent myself, and I've been for 20 years. There are plenty of people with very large incomes who don't pay the rent, or who have significant flaws in their credit history. Conversely, there are people with sterling credit, but that has nothing to do with being able to afford an apartment. You can have a 775 credit score, but you make $50,000 a year and you can't afford a $20,000 a month rental apartment. So here's the problem with all, aside from the folly of it, there's a problem, and it gets right back to affordability, which is this. As a landlord, if you're constrained on data, it means you have to be more stringent in that data. So for example, standard rule of thumb, 40 times your income to qualify for the apartment. Look at your income times 40, and do you qualify for the apartment as a general rule of thumb?
Which they also may want to get rid of that. It's a rule of thumb, but they actually may want to remove it as enforceable.
I don't know how you do that, but let's say as a landlord now, with more limited data, 40 becomes 50 or 60, because you don't get to see the full spectrum profile of your tenant's worthiness to be a tenant. And so what do? I'm going to take less chances. I'm going to be more stringent, and I will reject people that we normally accept. So as a result, it's harder to find an apartment. There are going to be more people putting in offers because they're going to be rejected elsewhere. And it has a negative impact on affordability. No one wins if you're limiting information to a landlord that's relevant and germane to the application itself. You're trying to determine if it makes sense because in New York especially, with the rules are such that evicting a tenant becomes a years-long process, and no landlord wants to go through that. Certainly no tenant wants to go through that. So to avoid that, you say, okay, give me a qualified tenant that's not going to have any issue paying the rent, and I'm good. It's a landlord. But now you can't make that determination. And the downside there is you're going to have to be more stringent on your approval process, which means less people will qualify. So if the goal here and everything we're talking about is to make the city more affordable, to get more people into homes easier, this doesn't accomplish that. This is a political theater, and this is a political spectacle. And it may sound good. Oh, now I don't need to show my income, but good luck getting that apartment. Because what will happen is, landlord will have to take an educated guess, I suppose. Maybe they look at your LinkedIn and see, oh, Jackie's been at this job for 6 months. Maybe, looks like her last 3 jobs she was at for 6 months, but she had a year gap between. So maybe not a good tenant. It's going to be harder for people unless you're wealthy. Because what'll happen is, okay, well, this person may not qualify, but they have parents who can guarantee it. So now what you're saying is you're going to get an advantage because of your family. If you come from money, that's unfair. I don't think that's right. I don't think that's how the mayor campaigned, exactly on the opposite in terms of his election. So you're going to make it easier for people who have money to get into apartments, or you're going to be a huge boon to the guarantee business, because more of those applicants, landlords will say, okay, I'll take you, but you're going to need to use a guarantor, or have a guarantor, use a guarantor service. I think guarantor services are about to have a huge boom in their business over this proposal if this gets enacted. Because I agree. Everyone's just using them.
I agree with a lot of the things you just said. I do have a couple fundamental disagreements, but we will mutually agree in the end result, which is higher rents, less affordability. So here is my biggest concern actually with the fact that you have to pick one or the other. By having to pick either credit check or income verification, you are most likely now increasing, not decreasing, the prospective qualified pool of applicants. And inventory is not going up. It's actually net dropping because ever since about 2029, the end of the boom of development dried up because of 421A coming offline, plus a lot of the private credit platforms started to dry up in regards to their ability to lend on the developments in New York. So what that led to was just less inventory coming online. But what happens is if you restrict the landlord's ability to use both to effectively qualify a person, if you think about it, the data that an application pools is intended to use to prove that a person is going to be qualified to occupy the apartment, be a good tenant, paying, and not have any fundamental issues in regards to their ability to be a good neighbor. And so when you look at those fundamentals, if you're now going to cut out one half of the financial qualifications that a person has to be potentially disqualified, I actually think you're going to increase the qualified pool, which means more people applying for less apartments. And all that does is lead to higher rents, right? Because you're again, simple supply and demand, more people, less units. And so I think what you're going to see, to your point, is I know a lot of people who make tons of money with poor credit that regrettably, some of them could take advantage of the system because now it's becoming even more difficult to evict tenants.
Right.
And so you have this pool of tenants that also are more challenging to get out who are not paying, which is going to increase the expense on the landlord. That rent, that net expense gets passed through to the tenants that are paying. I just think that what's ended up happening is you're creating a bigger pool of theoretical qualified customers that otherwise might have been disqualified because of poor credit or poor, unqualified income. And what that leads to is more demand with less supply, which equals higher rents. So if the goal is affordability, this is not the path to do it by increasing the number of people that qualify for an apartment without providing more units. I don't know how anyone can dispute that.
One of the other things I did want to flag, one of the other proposals was that the landlord or the broker would pay the application fee.
Credit check fee.
The credit check fee. And I just want to note two things here. If it gets kicked to the broker, in not every transaction, but in most transactions, the agent, it makes less than the client that they're serving. So you would potentially be having the lowest income person pushing it off to them. And then secondly, as you know, and sometimes we can get 20 applications on a rental. We had 30 in a recent one earlier this year. So
I have actually heard of 100 on an application for one unit before.
I'm sure. And so it's like, the landlord's going to pay for a credit check 100 times? Of course not. They're just going to whittle down beforehand and maybe in a final round run a hand. I don't know. But it's unfair to shift. If you're applying,
not forget, this is on the heels of the FAIR Act passing, which has already caused rents to go through the roof. So at the end of the day, if you're trying to solve for affordability, which is what the current mayor wants to do, regrettably, all this is going to do is increase the cost of living in New York City apartments because there are people that didn't qualify, that have chosen to live potentially outside of city limits, that now are going to be like, oh, wow, I can just pick which one to apply with, knowing that my credit is either insufficient or my income is insufficient. But the hope is that the landlord has no choice but to approve me. It's just a larger pool of people that are now qualifying for a shrinking pool of, a shrinking inventory pool.
Yep. That's where
what does that do? That leads rents up.
It's just up rents. Everything.
I do think, given the fact that we just highlighted the FAIR Act, before Eric cuts us off.
I was just about to say, we're starting to get close to that time, guys.
Jason, you want to give a quick spiel on the FAIR Act so that people that are watching understand what it is and how it impacted rents over the last 5
So prior to the FAIR Act, we had something called no fee listings where the owners paid the broker fee, and we had 4 fee listings where the tenant paid it. There was a market, and this got sussed out of the market. You could search for no fee listings if you were adamant about not paying a broker fee, or you paid the broker fee. The FAIR Act removed that entirely, and you can only collect a broker fee if you're hired by the tenant to represent the tenant and the tenant agrees to pay you. Otherwise, the landlord pays the agent fees now, period, hard stop. Sounds great for the tenant because they get to save on paying a broker fee in all cases, except that fee cost gets rolled into the rent now. Base rents went up. Year over year, rents went up 8.3% in Manhattan. And if you think about it this way, the typical landlord has been paying a broker fee of 1 month rent. What's 1 divided by 12?
8.33.
8.33, exactly the rental increase in the last year. So what happened is, and what's your next year's increase rent based on? Well, it's based on your base rent. So in perpetuity now you're paying higher rents because base rent just jumped over 8%.
Well,
so
also now you have landlords or brokers that have a fiduciary reason to say, I'm going to take a 1-year lease versus a 2-year lease. And if you have two that are competing against each other, they're going to most likely lean to take the 1 year because they're able to collect a fee every year instead of the fact that the 2-year would be one fee.
No, well, the landlord would prefer the 2-year because they don't want to pay the broker fee twice. So people in 1-year leases get disadvantaged.
Sorry, exactly. You just nailed it. Exact opposite. That's what I was trying to say. You now have people who are getting cut out because they want a 1 year, but the landlord is going to prioritize even potentially a lower rent on a 2-year because they want to not have to pay 2 broker fees.
We just had a client. They lost 5 apartments. We finally got them one. After another deal fell apart, they came back to us because they only wanted 1 year, and everyone else was saying, I'll do 2. And the landlord was like, great. 2 is much better because of the FAIR Act. So it's put the market in a bad spot, the rental market in a bad spot.
So agreed. I know Eric tried to cut us off. Sorry, Eric, we're back. What do we need? What do you need from us?
Whoa, that's a spicy one right there. So we're super excited about RE/MAX and having Chris Lim, RE/MAX president, on our board. ARA is now sort of flourishing around the country. The RE/MAX agents have been awesome. We are, for those who I have not emailed back yet, or one of us haven't emailed back yet, our apologies. The inbox has been flooded with our new members asking questions. We don't, by design, do form canned responses. Everyone gets a personalized response written by a human, not by a bot, written by someone on our leadership team. So you will get a reply, and they're coming. I know we're a little behind, but it's just because we have hundreds of emails from new members. So we're excited to have Chris aboard. And, for those in Missouri, I'm going to say it. I'm in the East Coast today, so I'm going to call it Missouri. When I go there, it is Missouri, just going to be clear. So we're excited to be working with the Missouri State Realtor Association to defeat ballot amendment 4 and 5, which had a very bad effects on affordability in the state. It would open the door for a transfer tax on property, which they don't have right now in the state, and it would limit good governance in the state. And so we were excited to jump in and work side by side with the state association there, and now we're working with local associations across the state. We're activating our members, and we're going to defeat amendments 4 and 5 on August 4th. So Tuesday, August 4th, primary day in the great state of Missouri. If you live there, vote no on 4 and 5, and you'll be hearing from ARA on this as we get closer to to primary day.
I can't speak to any of the political jargon. That's Jason's skill set, but I will say Chris Lim and Andrew Dodge both joining the board of ARA. We couldn't be more excited to have them on. And Chris Lim, who I've gotten to know incredibly well over the past few years, absolutely one of the most recognized, but also just most respected names in the brokerage industry. He has an incredible longstanding history, and we're really excited to roll up our sleeves with him and get going.
Yeah, it's very awesome. Chris is amazing, and we're lucky to have him. And it just speaks to the breadth and depth of ARA as we're sort of in this accelerated growth phase now. I think leaving startup mode might be someone said to me yesterday. I think that's sort of some truth to that.
That is not an incorrect statement. Well, listen, this has been great. I look forward to next week. Eric, want to close it down?
Sure. Hello, everyone. Eric Zollinger here. So I have a weekly Substack called Voices of RLTYco, and the very first portion of that is a real estate news update, news stories, the headlines that you might have missed. And so this is last week's recap. Welcome to this week's Voices of RLTYco. I'm your host, Eric Zollinger, with this week's real estate news, headlines you might have missed, but you should be aware of. Today is July 16th, 2026. The American Real Estate Association, ARA, has joined the Missouri Realtors in advocating against two proposed ballot amendments that they say could raise homeowner costs in real estate transactions. Amendment 4 would raise the bar for citizen ballot initiatives, and Amendment 5 would phase out state income tax and let legislature expand sales taxes, potentially including a sales tax on home sales without a public vote. It marks ARA's first policy partnership with the State Realtor Association. In last week's news update, I covered Texas Governor Greg Abbott's pivot on his stance towards AI data center construction. This week, New York Governor Kathy Hochul signed an executive order banning new large data construction across the entire state. The one-year suspension applies to data centers exceeding 50 megawatts that haven't yet received their permits to begin construction. Hospitals, research centers, and schools are exempt. The order gives the state time to develop environmental assessment, set consistent standards, and establish rules for how data centers can supply their own power. Also in last week's update, we told you about Douglas Elliman launching a new AI-powered data company built on Google Cloud called Elias. The Real Deal informs that CEO Michael Leibowitz said that the upgrade is going to lead to layoffs at the firm. I can't believe nobody talks about
AI to reduce the industry's overall need for agents over time. You know, it's part of a broader reckoning across residential real estate as brokerages weigh how much of the business AI can absorb, and agents weigh what it means for their own business. Last Friday, I commented after reading the Real Deal's New York Dirt email regarding the Manhattan market news, a Douglas Elliman report showing that Manhattan residential sales prices for Q2 2026 topped $8.2 billion. That's a 19.4% increase year over year. This was covered by Cranes. The data continues to suggest that New Yorkers are not fleeing the city. And there you have it. That's this week's news headlines up. So real quick, the Douglas Elliman report, I haven't been able to confirm from anyone yet. As far as, is it just closed sales? Is it contract signed? Because this is the first time they're doing their own report. Jonathan Miller is no longer doing it. I also don't know if it's heavily relying upon new development deals, which we all are very aware. Those are contracts that were signed like with the Waldorf Astoria that just started closing in Q2 6-7 years ago. So we don't even know if those are real transactions today. But what I do love about the story is that I will always bet on New York no matter what, because the city is resilient. There's always going to be people there. We just don't know what the prices are going to be, right? So you're here.
You're here. All right, listen, amazing. Jason, final thoughts?
Nope. We'll see you. Look forward to next week. We'll see what the week ahead brings.
Have a great week, everyone.
See everyone.